do you say to managers when they say, and I'm sure you've heard it, I've heard it a lot, I can't find the people to put in the jobs that I have available? Is that about training?
I think some of it is training, but I'm not hearing that from the companies I speak to.
That was Secretary of the Treasury Steve Mnuchin telling Maria yesterday he's not worried about a tightening labor market and that he's not hearing those concerns from business leaders that he's been speaking with. But among the top stories in today's Wall Street Journal, how bad is the labor shortage? That cities will pay you to move there. Joining me now is Principal Global Investors CEO Jim McCaughan. Jim, this does go directly, though, to something you factor in when you invest. It's that a tightening labor market, rising wages, rising prices, and then what the Federal Reserve does. So who do you believe here?
Yeah. I think you have to chart a fairly careful course here, Dagan. What I would say is that Secretary Mnuchin is getting his way because what we're seeing is an increase in labour force participation, interestingly, particularly at the younger and older ages. But that increase in labour force participation gives us a bit of runway for the economy to continue to grow. Now, it's actually healthy that there's a little bit of demand for labour. It means that pay is going up a little bit and could go up a bit more, and I think that is healthy for the standard of living, for consumer spending, for general prosperity. So I think that's what is going on in terms of the tightening labour market. The question for investors is, how long can it go? Is there still another 2 or 3 years of recovery here? Is there not? Because is it tightening so much that we're at the end of the strong period? Well, I think that we actually have 2 or 3 more years runway. So I think that equities should still be okay. I think that the Fed will be tightening a little bit, not a lot. And I feel it's a fairly benign environment, albeit a risky one.
Well, Jim, Mike Murphy is here. I bet you he agrees with you because, Mike, you've been bullish and still are.
I've been bullish. Hey, Jim, good to see you.
Yeah, good to see you, Mike.
You know, for years we've heard now we have no wage growth in the economy. That was the knock on the economy. Now we're getting the wage growth that I would argue we need, and yet some people are finding a negative there. I was just wondering how you see the current state of the U.S. economy versus the current state of the global economy, because I know through Principal you guys are investing around the globe. How does the U.S. stack up with, say, Europe or Asia?
I would favor the U.S. Somewhat over other markets, primarily because of the ongoing innovative and very creative nature of the U.S. private sector. We have technology, we have innovation in the United States, which is greater than other places. That means that our longer-term growth should be better than the rest of the developed world, and that we become, therefore, an attractive place to invest capital. There's some shorter-term factors here, like the new tax code, lower taxes on corporate activities. That means that we're drawing in capital from abroad. So I think all of that is pretty healthy for U.S. investing. It's not without risk, but I'm reasonably positive.
Jim, Jerry Willis is here.
Hi, Jim. Jerry Willis here. I'm just curious, though, about how concerned you might be about the Federal Reserve, because if there's anything that could flatten this cake, it's the Federal Reserve going too far. Often, they are the fly in the ointment. Are you concerned that the Fed might raise rates too fast?
This is one of my 2 or 3 concerns that are the probability that it turns negative. I do think if the Federal Reserve make 2 more rate increases this year, they are making a policy error. And if the rates go up too much, you will see recession before we need to have it. The mechanism that happens is, 3% 10-year yield we can live with. But if we had a 4% 10-year yield, that would be high enough to kill the housing market. That would cause a setback in housing, which could ultimately lead to at least a modest recession. I don't think the U.S. is primed for a big recession. This isn't going to be 2008. But policy errors could take us into negative territory, and that would be bad for the market. Last month's Fed meeting, you saw them talking about the medium-term outlook on interest rates. Chairman Powell talked about that. It was actually reasonably okay, but I still have a fear they might go too fast.
Jim, good to see you. We covered a lot of ground. Thank you for getting up early, Jim McCaughan, for us.
Thank you.